There is one potential black swan out there that I see that I don't think it's a near term risk. It's probably not a medium term risk. I do think that among insurers, there are a lot of problems. I think there's a
Mm.
systemic problem among insurers.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Stocks entered the year trading at or near all-time record high valuation extremes. So when stocks look richly valued like this, short-term sellers take notice. Is it time to start shorting the market here? To find out, today we've got the good fortune of welcoming back to the program one of the best known short sellers in the business, Carson Block, founder of Muddy Waters Research. Carson, thanks so much for joining us today.
Yeah, thanks for having me, Adam.
Hey, it's such a pleasure to have you back, Carson. I really enjoyed our first conversation and sort of the audience. So I've been getting a lot of requests, say, hey, when's Carson coming back on? So thank you for making the time here. Happy New Year, by the way. We're here still at the roughly start of the year. So to my question there in the intro about short selling, obviously, Carson, you're one of the best in the business. Valuations, when we talked last, were pretty stretched. They seem to be, in many cases, even more stretched right now. But looking at some of your recent writings and work and interviews, it sounds, and correct me if I'm wrong on this, but it sounds like you think the current cycle still might have some juice left to run. I don't get the sense that you're saying it's time to go short. Is that correct?
Yeah, so I guess it might be fair to characterize me as somewhat of an apostate in the short selling world. But, the comeback there is it's now a very, very small world when it comes to short selling.
Yes.
So there there are a few things here. The, when you talk about valuations, okay, prices have definitely decoupled from economic or fundamental value in a number of instances, especially for companies that are larger portions of popular indices. But the thing is, what there are reasons why that has happened, and you have, and this is a rabbit hole we've gone down a lot in our firm the past couple of years, where it really started with, well, okay, it started by getting beaten up on shorts for a number of years, right?
Mhm.
And got into these conversations, especially a guy named Mike Green of Simplify Asset Management, who's been out there banging the drum for years about how passive investing is warping markets.
Yeah, and sorry
And
to interject, but just to let you know, this audience is pretty familiar with Mike and that passive bid framework.
great. So I know Mike, and we started conversing about this, maybe late 2019, early 2020. And what then ended up happening is we had somebody in our firm who ended up developing a systematic strategy, a momentum strategy, where we were going long constituents of the S&P 500. And, it was just, we were measuring momentum in a way that's proprietary. But I was skeptical when he presented this to me, and he showed me the backtest numbers in mid 2024. And I mean, I was skeptical that there was real edge there, and it just sounded like it was too simplistic. But we ended up putting this into practice in October of 24, and I mean, we've shot the lights out. The returns that we've made on this are just they're almost obscene. And I really, as part of this and my conversion to really, I understood the arguments that Mike was making on an intellectual level, but I didn't really, my bones want to believe it fully because of my
Hmm.
orientation as a short seller. But having taken advantage of this effect, um, I do feel this in my bones. But we've gone down the rabbit hole, and look, we're not complimentary internally of the index providers, especially S&P, right? Like those S&P chases momentum when they add names to the index, especially the S&P 500 index, and the dynamics of market cap weighting create basically this recursive effect where
Hmm.
momentum just feeds upon momentum, and then the smart companies, which a lot of these companies understand these mechanics, they play into it through share buybacks. And so it that's why you have so many of these large companies where the prices are disconnected from what you would say the fundamental value should be. But should you short that? I mean, no. So long as you continue to get flows into these index funds, that effect is going to continue, and the fundamentals matter less and less. Yes, fundamentals can matter on the margins if there's a bad quarter, but again, it could that could shrink its given stocks percentage of the index. But if it's still on the winning side of that index, it'll continue to get flows. So it'll kind of just grow back up in proportion of the index. So no, you shouldn't go and in short Mag 7 because you think it's overvalued or what have you. What I think the future of traditional short selling is, now keep in mind, my firm, we're not traditional short sellers, we're activist short sellers. So
Yep.
for us, the idea has always been to use short selling as as an absolute return strategy. But generally, traditional short selling is not absolute return. It's there to smooth out volatility over the long term and also to allow you to finance your longs, the ones that you really like. Well, the case for traditional short selling as a volatility hedge or as a downside hedge, it's not really there anymore at present, or because when we have corrections, the corrections are so short in duration because the policymakers absolutely must prop up the markets. I mean, we are so, as an economy, we are so heavily financialized that we cannot weather the pain of a real market correction or a severe market correction. So policymakers have the motivation, and now they have the intellectual property. They developed it post GFC, and you really saw this put to use in COVID when that correction was so short in duration. So that's why that traditional view of, well, I want to allocate to short sellers as a hedge, for when the market corrects. That's why that no longer holds water. But to finance your longs, yes, but the problem that, short selling traditionally has been this discipline where you go out there and you say, okay, I want to find the companies where the price is the most disconnected from the value. Another way of phrasing it is, I want to find the most screwed up companies. Now, when you get those massive disconnections, it's almost always because the company is actively doing something to cause that. They're hiding the ball, they're misleading investors, they're doing things to manipulate the perception of the company. So in this environment, trying to identify those shorts to use them to finance your longs basically is a bad idea. So if you look at any given index and you break it down into quintiles or deciles, right, that leftmost, in terms of the ones that underperform ultimately, where they really crash, that's what everybody's searching for in terms of their mentality. But the thing is, a lot of those that ultimately have those spectacular crashes, they just run hard. They rip
Hmm.
for an unknowable but often long period of time before they crash. So rather than chasing that leftmost quintile or decile, I think that the discipline, if you're a traditional short seller, as in non-activist, needs to be that you're going in there and you're looking for the quintile or the decile that's going to be just a little bit to the left of the index mean. The mediocre companies that are kind of just sleepwalking through things, you're not finding anything revelatory. You're not really finding things that the world doesn't know. You're just looking for those who are lagging the average, the mean performance of the index, which isn't that hard because it's only usually about 20% of the companies in, like an S&P 500 or a Russell 3000 index it's only about 20% of those companies usually that equal or exceed the mean of the index performance. The mean
Or in
is
the S&P
driven,
case, 20 companies, not
right.
20%.
Yeah, exactly. Like that mean is driven by a really small number of companies. So rather than looking for the ones you think are going to be the worst, just look for the ones that are, kind of, somewhere in like the second, third quintile, um, or the third to, sixth decile, basically. That's where I think, and you know what? And that's a horrible job. Like it's not intellectual. Smart people don't want that job. So I think that's why, as a practical matter, it would be tough to make that adjustment. But that's the adjustment that should be made if you say, hey, look, by being short these things that are kind of mediocre, that are just going to underperform, I can really concentrate more in the things that I have confidence in, that I really like, because when there is, beta move downward, I will have some cushion there, but I'm not looking at this as like an insurance policy, because I think the market's really volatile and going to crack hard. And, I like it's not a pre-GFC market anymore. You just don't have the frequency of corrections and the duration of corrections that you used to have.
Yeah, and it sounds like that because there's several things that are going on. I don't know if we can call them unnatural or not, but they are trends that weren't there, let's say 20 years ago, that have a strong bias to keeping the market supported here. And this audience, Carson, it's not a bunch of aggressive short sellers, but I think there are a bunch of people in it who are believers, long-term believers in that stock should reflect fundamentals. They're looking at these distorted valuations ratios, particularly given the scope of history, and saying, "Oh my God, they're at historic extremes. This can't last. Maybe I should go short this, right?" And I hear you saying, folks, it's a risky game, and a guy who's very experienced in short selling like you. And we'll talk about the difference between active and passive short selling in a second. You're basically saying, I wouldn't touch that. Or if I
Yeah.
would, I'd do it in the very boring way that you just mentioned.
Right, exactly. I wouldn't be looking to hit home runs on the short side if I were doing this in a non-activist way. But yeah, just so long as you have net positive inflows into into the index funds, and a lot of that's target date funds, the 401ks, without a meaningful rise in unemployment, that's going to reduce contributions to the target date funds and cause people to draw on those retirement savings. Until you get to that point, you're just fighting this incredible river of money. Now Mike Green does say, and I don't disagree, that the fragility of this situation is significant, but I don't think, we're anywhere near where we have to worry about that fragility, basically, where the flows start reversing. Because
Yeah.
yes, when the flows reverse, you don't have a lot of active managers left to catch these falling knives. And because of the disconnect between prices and fundamental values, especially with the larger names in the indices, because that is such a large disconnect, those knives would have a ways to fall anyway, even if you did have a lot of active manager dry powder on the sidelines. So it is a very worrying, from a long-term perspective, it's a very worrying situation. Um, but I'm not presently. I wouldn't lose sleep over it. In the near to medium term.
Okay. Well, and so I got a bunch of questions I want to ask you that I asked Mike, but I want to hear your answers to them. Um, if we can, let me just give you the open invitation here, Carson, which is if and when you get to that point where you start losing sleep, after you've told your Muddy Waters customers, you got an open invitation to come on here and tell these folks as well.
Well, I mean, look, okay. So from a short seller perspective, I mean, again, you said we'll go into what activist short selling is versus non-activist or traditional. I mean, we've done well in these bull markets. So it's never easy on the short side, but
Right.
I'm reasonably sanguine about that. I
Right.
mean, if we
Hey,
get
sorry
to
to
the
interrupt, but
point,
just so folks understand activist, um, that's where you actually can sort of have some impact on the destiny of the company. right? Where you see a company, you think it's doing something distortive, kind of deceiving the market, and you say, okay, you know what? I think I can, take a short position on this company, and then I, as an activist, can come in and I can kind of poke that weak spot and hopefully make the market aware that this company has an Achilles heel that maybe it didn't realize before. Is that a good sort of simple summation?
Somewhat. I would add to it that the focus on in short activism is on the past, right? So it's just, did the company accurately present material information? Did the company present all material information? So the first one is, has the company told a lie of commission? Has the second one is, has the company told a lie of omission? And the
Hmm.
third question is, does the market understand the information the company has disseminated? You
Hmm.
usually don't get a misunderstanding without either a lie of commission or a lie of omission. But basically, we're looking for companies that have egregiously misrepresented things in the past. So we're not out there saying like, oh, this competing product is, it's a lot better than people think, and it's going to take market share. We're generally not looking into the future. So
Yeah.
it's
Just
backward
saying, hey,
looking.
hey,
So
these guys cook the books, and I've got the receipts here now. Yeah.
yeah, it's very similar to journalism, like to
Hmm.
investigative financial journalism. So,
Yep.
we are investigative financial journalists when we do this. Our revenue model, though, is shorting the stocks versus selling ads or subscriptions.
Right.
Um, but so that, that it gets harder, I mean, every year the market goes up, investors are more and more anesthetized to risk. But on the flip side, the more egregious behaviors that used to be confined to lower rungs of market cap, well, now you find them in companies that have more cap and more liquidity. So we'll do okay there. Now, will I lose sleep when I think we're getting to the point where markets are going to implode? I guess, yeah. I mean, look, I haven't been there since COVID, and in COVID, I definitely lost sleep. But yeah, I don't see that. I don't see that on the horizon, imminently. But certainly, I'd say for most of these financial crises, I've been early in my life. Back in, I think, 95 or 9, no, 96 or 97, I started calling it a stock bubble. Um, Good thing I didn't know how to short at that point.
Right. Because it still
2000,
had 3.5 years to run from that. Yeah.
yeah, 2003, I started calling it a housing bubble because I was like, there's no way homes can go up double digits, when
Yeah.
inflation is this low. Good. I mean, unfortunately, I didn't buy a house at that point in time because I thought that it was ridiculous. So,
I'm right there with you on that, brother.
yeah.
We
So
knew too much too soon. Yeah.
I know, right? Like, you know, one of the best and truest things I've heard said about investing and maybe just life in general, but especially the investing industry, is that when you speak with them, pessimists sound smarter than optimists. Optimists live in bigger houses.
Yeah. Yeah. All right. Very well said. Well, all right. Well, look, just to reiterate, if and when you get to a point where you start not sleeping well on this, please come on the channel and let us know why. All right. So, I've talked with Mike at length multiple times about his passive flow framework. Actually, I'm going to actually see Mike in person in 2 weeks, so I'm looking forward to that. So that should be fun too. But uh, Mike, first off, he doesn't like this, right? He's not happy about it. He doesn't think it's healthy for markets. He thinks that it is distorting prices, and at some point, if and when these capital flows go into reverse, these net flows go into reverse, he thinks it's going to be highly damaging to a whole bunch of people. But it sort of just is what it is, right? We trade the market we have, not the market we wish we have, right?
There you
Um,
go.
so, I often ask him, okay, well, what are the most likely contenders in your mind to change the status quo here? And generally, what I hear from him is it would probably have to be a weak enough jobs market that the monthly flows that are coming in from these retirement plans, they start shrinking, right? You've had enough people laid off that there's just fewer funds that have to be invested every month. And as that starts shifting from net growth to shrinkage, that's kind of when the wheels come off of this thing. Is that your top contender as well, or do you have a different understanding?
Yeah, look, my views are highly influenced by Mike. And look, I've read some of the same source material he has, but that, that is my view as well, that once you start getting enough layoffs such that there are more people withdrawing money from their retirement accounts than contributing to them, then yes, I think that that's when the wheels fall off.
Okay. Let me ask you this. So obviously, if the unemployment rate spiked above 6% or whatnot in a short period of time, maybe we could have that, right? What if we just had a jobs market that didn't grow much? So unemployment or the employment levels kind of stay where they are, but we have more and more every month baby boomer retirees who are not working anymore and are starting to withdraw. Will that demographic wave eventually pull this thing under?
Well, yeah, and then you also have, it's not just that the baby boomers who are retiring, but then you also have, those target date funds that are targeting the eventual date of your retirement. They shift more from stocks
The
to
bonds.
bonds anyway, so they're selling those off. But there's still somewhat of a, as bonds rise in value, then you still have to balance it by buying equities. But yeah, there are conditions under which, even without an abysmal unemployment rate, and look, I'm not really the person to ask what that rate is, but you said 6%. Like 6% doesn't scare me. I
I pulled it
remember,
out of the air. Maybe it's
yeah,
not big enough. Yeah.
I remember when I was at USC as an undergrad in the mid 90s and was taking one of my 200 level or 300 level macro classes courses, and I think we said that the natural unemployment rate, the estimate at that time for the U.S. economy was in the low sixes. And,
Oh,
and we've gone well below that, obviously. So, of course, the flip side is that labor force participation rates have dropped.
has dropped.
Um,
Yeah, we've got over 100 million U.S. adults not doing anything or considered outside of the workforce. We'll put it that way.
yeah, yeah. So, but basically, I guess that's the other problem, right? When you get into, if you're really going to be focused on the number, what is the unemployment rate? There's so many caveats to the unemployment rate and other government statistics, obviously, plus the fact that I'm not sure that, BLS is going to produce bad news, for at least the next 3 years anyhow.
Right.
I don't think you can, I don't think it's smart to try to come up with a number. The employment rate hits this, then I'm going to panic. You'll understand, you'll feel in your interactions in the economy. If you can find a babysitter easily, worry. I can't
That's
ever find one.
that's a great real world indicator. Look, I was asking the question not so much to try to peg the magic unemployment rate, but just to ask, does this thing have an inevitable expiration date on it because of the demographic boom? Will it get so big of the retirees that their withdrawals will force this thing negative at some point?
Look, that's the theory, but the other countervailing force, and I alluded to this earlier, and I do think that Mike, talks about this as well, maybe not in this exact context, but it's the fact that policymakers have no choice. So in a pithy way, I like to call our financialized economy the powder keg economy, right? Because, we stuff it full of powder, which is leverage. It eventually blows up, and the only response is to build a bigger keg and put more gunpowder into it.
Mhm.
And so, with some actual preparation, not that the government believes in doing that anymore, but, maybe we'll actually get to a point in our politics where some foresight is actually politically rewarded and enters the system. So I guess what I'm saying in a sarcastic way is that we might end up, we might end up anticipating this. We might end up preparing for it. It might not be the sky falls in. Warren Buffett was always fond of saying, never bet against America.
Right.
You know, uh, Again, my best feeling is that there's no imminent issue. And, short of like those UAPs attacking us and destroying humanity or something like that. But, I guess it doesn't really matter, if you're long or short financial assets at that point. But, yeah, so I think don't lose sleep over it now. As the problem, as it becomes more obvious that where the flows start netting out, on a more frequent basis, um, then, assess the situation. And maybe there are preemptive policy measures that can be taken, or, you know, maybe it's maybe it's time to go to cash and, just get out of the way.
Yeah. All right. Let me make a statement here, and you correct it in any way you like. So what I'm kind of taking from you, Carson, is sort of like what I take from Mike is, I don't love this, but it's the way it is. Um, these are my words, not yours. Um, the passive bid is kind of like a sword of Damocles hanging over investors, where everything's fine as long as the thread doesn't break. We just have no idea if and when that thing's going to break. But right now it's holding. And so right now, you know, you're sort of like, I've kind of learned to love the passive bid as an investor because I can use that to make money. I can use that to outperform. And so you're choosing to do that, but you've got, one eye always up at the sword, trying to look at the thread and seeing if that thread looks like it's getting any thinner. Right now, you're not seeing any near-term signs, so you're dancing with the devil, if you want to put it that way. And you think that could continue for a good long while. So until you see signs of that thread starting to fray, you're going to put this to your advantage on the long side.
Yeah, look, because if you go back and you look at the last three major crises, well, let's look at the last four, one of which wasn't a financial crisis, but it was layered on top of the internet bubble burst. Okay, so the internet bubble bursting was foreseeable. The timing, no,
Yeah,
that it would be in March of 2001. No,
right.
that wasn't foreseeable.
But guys like
But
you in '97 could see this is probably going to end in tears.
right,
Yeah,
right. That 2008, the implosion of subprime, the implosion of real estate, the implosion of credit, that was foreseeable. There were a number of people who did foresee that. Um, Now, 9/11 was not foreseeable. Its immediate financial impact, was material, but not, but it obviously was worse coming on the heels of the internet bubble bursting, but it wasn't that significant. But that's something that's unforeseeable.
yeah,
COVID was unforeseeable. So yeah, you can always have a black swan event like that. But what I think, and COVID taught me something that actually was formative for me in terms of, my apostasy, I suppose, as a short seller, which is there is a tremendous resilience to our society. And so as fragile as the market is because of passive, people are resilient. And like it's unfortunate that a lot of times the things that are glaring problems never do get addressed until there's a crisis, but
right.
they get addressed, and we have successfully addressed these. And I remember in the early days of
And
COVID.
sorry to interrupt, but I mean, addressing to your point of the powder keg economy, it's rarely by fixing the issue, but just by window dressing it enough that it doesn't look, or maybe not window dressing, but artificially papering over it so that we can
Well,
continue.
Well, keeping it going. I remember, so back in 2005, I sat down with a friend of mine. He's really a friend of my father's. He had his own global macro investment firm since the 70s. And I mean, he was really one of the early American EM investors, actually. And his name is Monty Guild. And so I sat down with Monty, and I'm just like, oh, the housing, we're headed for another Great Depression, and this is like there's no way out of this. And Monty said to me, he's like, look, I agree with everything you're saying about the problems, and I do think we are going to have a real correction. He said, but when I was a young man like you, I used to think that and I'm talking the 1970s, the 80s, I used to think that the global financial system, was too fragile of an artifice that it couldn't hold. And and I was waiting for it to implode. And what I've seen time and again is they can put the toothpaste back in the tube.
Yeah.
And I think that's correct. And I philosophically don't agree how they did it. I mean, in 2001, or I'd say by 2002, I was apoplectic, looking at the response, to the internet bubble imploding, just to cut rates to, I mean, back then they seems like they were, like we thought we knew what, zero rates were, but
child's play back then.
yeah, I was apoplectic about that because to me, this did not address, what I kept saying in 2002. My verbiage was surplus capacity. We'd created all this surplus capacity in the economy through unproductive capital investments that were funded by artificially cheap money. And, it's like, so we're just making money even, artificially even cheaper. But I don't agree with the methodology, but the results speak for themselves. They do put the toothpaste back in the tube. And we saw that following the GFC, which, they didn't have those tools, and they also didn't have the political will back in 1929 to do this. So they do have the political will now. We're trapped in this cycle. I mean, in theory, we come to this, we come to this juncture in the road someday where you can't do it. But then look at Japan. I mean, this is, Japan's been doing this for a few decades. I mean, back when Japan started just, trying to reinflate its deflated bubble, you had all the Western economists, saying, oh, this is wrong. You can't do that. It won't make sense. It won't work. I'm like, it's not that Japan's is without problems, but they've kept that going for, 35 years now. So because there is a societal need to fix the problem, I do believe in this resilience. And look, to me, the real smack in the face that taught me this was during COVID, because I had, a good friend of mine I'd known for a number of years, professional investor, he went out and started buying shares in the cruise lines. Mm-hmm. And look, I'd already felt that cruises are just kind of nasty, like they're floating petri dishes.
Right,
and now
right.
like everybody on them is getting COVID. And
right, but they were radioactive during COVID. Yeah, exactly.
Yeah, and I'm like, dude, nobody's gonna go on a cruise after this. There's, that industry is ruined. And he's like, no, they're installing sneeze guards. I'm like, sneeze guards won't help. It's aerosol. Like, and he just went on buying, and I went on freaking out. And guess who was right and guess who was not right? Yeah. He was right. Cruise lines rebounded. He made money. And, in July, actually it wasn't until August of 2020 when everything's ripping and we're like, yeah, we got to reduce short exposure here. Like all those easy gains we had early in the year, we've given many of them back. Mm-hmm. So, so I've learned the hard way. And, the phrase that, you've used a phrase a few times during our conversation here about, that's very similar to something that I say. It's a criticism of short sellers. And that is, and look, this was true of myself, and hopefully no longer is, but, on the short side, I think we really have a tendency to see the world the way that it should be, not the way that it actually is. Mm-hmm. And, and that's also the case with businesses. When you go and you short a company because you're like, there's no way they can get out of this. That's also failing to understand that people are resilient. I mean, Tesla's a great example. How many times over the years have the Tesla shorts just screamed that Elon's done? Nobody is more resilient than Elon Musk. Look, I used to be one of them. I thought that he basically jumped the shark in 2018. Mm-mm. So, you can't overlook the resilience of people, of companies. Not every company avoids failure. Not every company bounces back, but I do think that, as a society, and it might not be pretty, and I might not agree with how we implement the recovery plans, but we are resilient, and just people just need not or should not lose sight of that.
Right. Or I'm taking from you is discount that resilience to at your peril or your danger. Um, all right. So I've actually, this is going to be a great bridge to a question I have here for you. Um, one other thing too that I'm kind of taking from what you say, and I've mentioned this in the past, is um, it's resilience, it's what you're talking about, but it's also just self-preservation of the system. So if you're betting on a reversal, you have to just keep in mind that every part of the system is fighting you, right? It's fighting to, the people that are benefiting from the status quo, the big parties that we all love to hate, they're going to do whatever they can to keep their advantage. Everybody in government is going to do everything they can to keep any sort of pain from lasting for very long. And even the public themselves will oftentimes ask for more of the same type of rescue that guys like you and I think have created the distortions. But I think, in COVID, we let a new horse out of the barn or genie out of the bottle with direct payments to households. And I think we can probably feel pretty confident the next time things start feeling painful, public's going to ask for that again, and politicians will probably give it to them. So you have to just keep in mind that this whole system is fighting you.
Right. Yeah. And the thing is, when you have an potential economic calamity, that's deflationary. So what does that automatically create license for, you know, the central banks of countries that borrow in their own currency, or really the US? What does that create license for the Fed to do? Print money,
Prince.
right? It's, and I mean, what it ends up doing is redistributing, right? Like there are on the back end of that. I mean, even if you say, well, in aggregate, GDP has increased, but there's obviously a transfer from you know more people to fewer people, because especially if you're long financial assets when you catch that reinflation wave. But so it's not to minimize the deleterious effects of this, but the reality is that's the policy response, and they have a lot of room to maneuver. And again, going back to what people what I think people get wrong, there I don't know that I'm not going to argue that the Fed and Treasury, are stacked with like our smartest minds, but they have a lot of people, and there are lots of people who spent years, theorizing as to what the proper policy responses should be in a Great Depression type scenario, or edge of the Great Depression, scenario. I mean, Ben Bernanke had written, that was, I think he wrote his PhD thesis
Well, that's what they
on
called him, Helicopter Ben, because of his PhD thesis.
yeah. So it's so they'll the biggest problem that the U.S. had in terms of trying to stave off the GFC when Lehman failed was a political one, that the authorities did not exist. Although it's kind of funny, they suddenly found the authority when it was AIG, not Lehman, because AIG was like that was the real like holy shit type moment there. But they'll eventually the politics will line up, and what needs to be done to try to pull things out of the nosedive will happen, and they'll probably succeed.
Okay. I'm getting to the question I referenced, but now I got to ask a question that I think is on a ton of people's minds, which is, um, hey Carson, I get it. Maybe I'm a little surprised at your new apostate role, but I'm following the logic that you're mentioning here about not to step in front of this juggernaut prematurely. Um, but I'm worried that, if the system does get out of control for at least a little bit, you're saying, yes, the reaction function of the central planners is going to be fast and furious, but I don't want to be collateral damage in the period between when the thread of the sword of Damocles breaks and then the central planners respond. I don't want to lose 30%, half, 50% of what I have if there's a big drawdown there. Um, Do you worry let's say the sword thread snaps for a bit. I know you think the policy folks are going to respond as quickly as they can, but in the interim, how bad do you think it could get given the distortions of the system?
Well, I mean, certainly equities, would be pummeled. I mean, your S&P 500 index, and nominally, right? Because those companies that had led the way up are going to lead the way down,
Hmm.
would be, I mean, it would be a crash. Um, that would certainly have knock-on effects. I mean, you'd immediately have, credit markets responding and credit markets free. I mean, liquidity would recede
Ice
instantly.
up, yeah.
Yeah. So you would have real world layoffs. You'd have diminution in other asset values. It would be, I mean, it would be similar to the GFC, but probably the movements, the downward movements in the markets would be more profound. Um, so, I mean, in the short term, look, you know, as as a matter of just general principle, you don't want to have too much leverage, right?
Right.
And this is
Hmm.
also where having a real asset and so owning a home, but not having too much debt on it, would be a benefit, right? Don't have all you certainly don't have all your eggs in the equity market basket. I mean, particularly if you're at the point in life where you're middle aged or older.
You don't have a lot of time to recover. Yeah.
Yeah, you don't have a lot of time to recover, and you don't want, and if you have a job where if the job goes away because of damage to the real economy, you do want to have a cushion. I mean, if you're listening to this and you're 26 years old, I mean, you can't wave a magic wand and suddenly have, reserves, but then on the other hand, time is on your side.
Hmm.
So yeah, I just think it comes down to, at the end of the day, you have to be prudent and you shouldn't ever get too greedy. So if you're hearing me talk about, the equity market, at least the index, that's going to rise until, the world falls apart. Okay, like, if you like that thesis, fine. You want to play along, great. But don't go all in or anywhere close to all in on that. Right? You know, have a cushion there. So that's, I just think it's basically, that's where I know a lot of people in a bull market, people will deride diversification as diversification. And
Right.
like, yeah, okay, but where it works is when things do become somewhat semi catastrophic.
Okay. Um, and in terms of duration, I know I'm asking you to prognosticate a lot here, so I understand that this is just gut feel here. We're not holding you to any of this. But going forward, it sounds like you think that market downturns like this, or we'll call them sort of systemic downward surprises like this, they're gonna be more kind of like the COVID era in duration versus the GFC era, right? GFC, we had multiple quarters of it just feeling terrible, and it took a while before people started to feel like it was getting better. COVID was almost kind of like you blink and you miss it, right? Markets
Hmm.
plunge, but then they recover pretty damn quickly because the reaction function was so sharp and so unprecedentedly massive.
Right. Well, yeah, look, I think, I do think that's the case. And actually, I hate to do this to you because it's kind of out of sequence. I mean, there is one potential black swan out there that I see that I don't think it's a near term risk. It's probably not a medium term risk. I do think that among insurers, there are a lot of problems. I think there's a
Mm.
systemic problem among insurers because, you've had this situation where a lot of insurers have been acquired by private equity. These ratings agencies that, will rate the bonds are, once again, reasonably pliable. I mean, actually, let's call it corrupt. And so they're using the assets to fund LBOs to basically build their businesses. The other thing that's really funky about a lot of insurance, and I've never understood the case for this, is you have captive reinsurers. And those captive reinsurers are often in jurisdictions in which you have very little transparency or visibility into the financials of the reinsurers. And so, what a game that I suspect a number of insurers play is, they cede, liabilities to their captive reinsurers, and they'll inflate the value of the liabilities that they've ceded, meaning make their balance sheet appear to have fewer liabilities, and
Yep.
they'll inflate the value of the reinsurance asset that they get, because probably the stuff that's on the balance sheet of the reinsurers, even bigger garbage. So I do think that that could be a systemic type issue, especially because, and speaking with somebody recently who's done work in this space, he said that like a lot of these really the poorer insurers are just reinsuring to each other. So you have this like web of like crappy insurers, poorly capitalized insurers that are reinsuring each other's, balance sheets. Um, but a lot of times these insurers issue life insurance and annuities. So these are long tail liabilities. So it's not clear to me that there's an imminent risk, but you know, again, like let's say that blows up. And so if you had that blow up in a big way, one, I think you would see an immediate impact on the credit markets. You would have liquidity would recede, because these guys are obviously big players out there in terms of providing liquidity for,
Right.
acquisitions, et cetera. Spreads blow out some, but I just think, the government has the toolkit to go in and fix it. I mean, maybe there's, a gap there during which there's some real world pain, but, rates get cut, Fed buys bonds, does what it has to do. So, but that's another hiccup. I
Uh,
shouldn't call it a hiccup, but that is something that I do see that could be a problem at some stage.
that's super interesting, and I'm resisting the urge to try to peel that onion with you. But given the time we have left, I want to squeeze in a few more questions before we're done. And you answered my big one on that, which is when you mentioned it, I was like, whoa, what happens when the backstoppers can't do that anymore and need their own backstopping? But it sounds like you think it's not a hole that's too big for the Fed and the other central planners to fill.
I mean, again, like that's the beauty of all these problems. They're deflationary, right? So that gives you lots of headroom to just print money. Now in Europe, the response is always going to take longer because, you've got multiple nations that have to agree, the ECB, none of them, they all borrow in a common currency, not their individual currencies. So for them, they're always going to move more slowly. But,
Right.
in the US, to date, um, it's a great thing that we get to borrow in the currency that we print.
All right. Great thing for us that benefit from it, and that's largely the asset owners. Not a great thing in the long run, especially for those who don't own assets. And you're nodding as I'm saying this. All right, if you don't mind, then just given the time, I want to do a little bit of rapid fire with you, if we can.
Sure.
And by the way, Carson, this is great. I'd love to have made this a 3 hour interview, but I understand we got to
There's
be
not a market.
respectful.
There's not a market for 3 hour interview with me.
It's funny though. I have yet to find the maximum tolerance level of this audience. I've done some interviews that have been 2+ hours and had people say you should have kept going. So it is interesting. There is a cohort of very thoughtful people out there that really like this deep discussion. Um, so I was just listening to an interview with we were talking about the All In guys with Chamath was interviewing Howard Lutnick. And it was actually really just, it was super fascinating. I recommend it on X to anybody who just wants to get a better understanding of our tariff policy and love it or hate it. I think it's a really educational discussion about kind of just why the current tariffs were structured the way they were, how they get structured that way, and then just mechanistically how it all works. So super interesting. And I'm not saying you have to necessarily share this, but listening to folks like Lutnick and Scott Bessent and whatnot, I mean, obviously they're going to be putting out most optimistic guidance they can because they're the guys that are running the system. But they are really saying, hey, look, we have laid a lot of pipe in 2025 for economic tailwinds that are going to start beginning this year, and some of them are kicking in now. And they're saying, look, don't be surprised to see 5%, maybe even 6% GDP growth here in 2026. When it comes to the current estimates for GDP growth for 2026, are you more willing to take the over or the under?
Um, I thought this was going to be a tariff question, you
Yeah,
know.
sorry.
Um, ah, yeah, I'll go with the I no view on that now, but I do have something on the tariffs
Sure, go for
though.
it.
One of the things, because we've done a lot of work in Vietnam, we have an office there, got a tiny fund that's been investing long in Vietnam. And one of the things that we learned from that was when the tariffs were imposed, I think this speaks to why they're a bad idea, but also why they don't really seem to matter when it shows up. Um, is that all of these exporters and also on the import side, same incentives. They basically said, oh well, you know what? Actually, since these tariffs are only levied on products, well, there's a lot of IP that goes into my widget, and so basically what we're going to do is we're going to say that this is really IP, it's a service. So when the manufacturer, the exporter, I'm selling this to you, this portion is actually the IP I'm licensing to you, so the widget cost is much lower.
Huh.
And so like that's why I don't think it's mattered much, because everybody has then tried to engineer around it so that it's not that impactful. Why that's a bad idea? What is that like? That's exactly the US tax code. Okay? The higher you make taxes, the more guys who can afford it like pay, just I mean, when you step back, I'm not like a huge Arthur Laffer fan, but I heard him interviewed once, and he was just talking about what an absolute waste it is that we spend so much of our wealth on guys who are trying to figure out how to engineer, like, through the cracks of rules and
Right.
laws, tax savings. So like that's basically what I think we've, the net result of tariffs is, I mean, obviously there's some increase in the cost of goods, right? And the Treasury has collected some money, but the reason I don't think it's really been that profound is because you've just forced people to, turn into high income American taxpayers and hire, think of creative ways to, minimize the taxable values.
Okay. I'd love to dig more deeply in that too, but we'll have to say that for a different discussion. At a higher level, let me ask you this. Um, the world does seem to be fracturing into trading blocks versus the era of globalization that preceded it. Um, in this new world trade order, um, if you're looking at the risk board, um, whose prospects do you favor most? US, China, somebody else?
Well, so that it's actually that, my mention of Vietnam was great because in April of 2020, my revelation was that coming out of COVID, it was going to be the biggest geopolitical realignment since World War II. And it was going to be about each country in the world, its relationship with China. And so, what I saw as the biggest net beneficiaries overall be the countries that are non-aligned. So, like your Vietnams or Indias. I mean, if you look at Vietnam, for example, Vietnam does not like China. They cannot, they cannot ever trust China. But by the same token, they cannot anger China. And, it's interesting the Vietnamese perspective on the war in Russia and Ukraine shortly after that war started. What Vietnamese government officials would say is they thought that was actually Ukraine's fault because Ukraine did not balance its neighboring giant with the West. So I think that the winners, the biggest beneficiaries of this world are those that can play the United States and China off one another.
Okay, so maybe poor analogy, but sort of the Switzerlands of the world, the countries that can be more independent versus just bolted to one superpower.
Yeah, yeah, exactly. But I mean, from a trading and economic perspective, I mean, Switzerland doesn't have like a ton to give the world anymore. But from but I really
Exactly,
like
which is why
countries
it's not the world's best
like
analogy.
Vietnam.
Yeah.
Yeah, but like Vietnam and India. And I mean, look, we're very bullish on India. We're in the process of launching an India fund as well. So and this is not just me talking my book. Our book is reflecting that, my worldview there, that these less aligned or non-aligned countries are the ones that are set to benefit the most. I mean, obviously, look, with the problems in the relationship between the US and China, that's bad for the US in certain ways, that's bad for the Chinese in certain ways, it's bad for the Europeans in certain ways. But it's, so the countries that were kind of insignificant and aren't really the movers and shakers of world affairs, they're the ones that I think are best positioned.
Okay, great answer. Um, all right, so uh, I'm going to ask you about gold, and I'm going to ask you about gold for two reasons. One, because when I was doing research for this discussion, you've had your firm's had some comments in the news about gold. You also mentioned, you know, the prudence of owning some real assets in the current environment, as you told us a few minutes ago. I do have to say, though, before I ask the question, um, uh, it sounds like your firm has taken a long position, or at least identified as a good long-term play, or long play, a company called Snowline Gold. And I mention this only because I own Snowline Gold. So I've got
Oh,
a selfish interest in your answer, but I also just want to be transparent here, folks, that I'm asking a question about a company that I actually own in my personal portfolio. But gold and silver have had a phenomenal year in 2025, and the momentum is continuing as of the day we speak. I haven't looked at it since we've been talking, but this morning, silver, I think both gold and silver futures hit all-time highs yet again. Silver was like 89 something. I mean, bananas. uh,
mhm.
so, one, I'd just love to hear any thoughts you have right now about kind of what's happening with the metals, what you think might be driving it, how sustainable you think this is obviously the big question on a lot of people's minds who have been precious metals investors for a long time is this the great repricing we bought in for and we're hoping for, or is this a blow off spike like we saw in 2011 and 1980, and is this going to come crashing down and be dead money for the next 10 years? So love to get your thoughts on that, and then anything you want to say about Snowline Gold, I'd be very interested to hear.
Sure. All right. Well, I'm gonna disappoint on the first one. We launched a junior mining fund in 24. I mean, had phenomenal year last year, even though we run it on delta adjusted basis, only net 50-60 long. Our macro thesis on launching the funds didn't have to do with metals prices, though. And our macro thesis on why you should invest in junior mining if you know what you're doing is that there's been a massive underallocation of human capital to the mining sector for the past
Mhm.
couple of decades. Smart people have not I mean, it's a miserable lifestyle to be in a mine.
They've been running out
Um,
of engineers, right? Like the
yeah,
folks just don't
yeah,
want to go into that
right,
profession or hadn't wanted to. Yeah.
right. So there's real edge if you know what you're doing in looking at junior miners and interpreting the data. And look, we brought somebody in who does, in my view, have real edge. Otherwise, we wouldn't be doing this. So, we don't, our macro thesis had nothing to do with the metals. I mean, look, at a high level, we believe, to the extent that, society does get serious about increasing the amount of electrification of, of our economies, like that means a lot of stuff needs to be pulled out of the ground, the base metals, particularly copper. Um, as for gold, I mean, yeah, look, everything I've said about the consequences of our financialization of our economies and the policy responses, you know, does imply that over the long term, like gold is going to continue to go up and to the right. I mean, gun to my head, do I think it really corrects for a sustained period of time from here and that these are like all-time highs? No, I do not. But that's not really, that's me somewhat outside of I'm definitely outside of my lane on that one. For us, it was really about the lack of human talent in the operating space and also capital allocation side of resources. As for Snowline, yeah, I mean that to us, we think a major is going to have to acquire it. I mean, majors have not spent much money on greenfield exploration, since the GFC, and I mean Snowline is really the only deposit. I mean, and first of all, it's in a functional jurisdiction, right?
Hmm.
It's in Canada. We think it has the potential. So some of the concerns about it have been like, well, logistically, it's remote, it's in the Yukon. There is infrastructure there. They will have to develop the road network some, but we think that this deposit, or that these deposits are so significant that this will turn into a mining district, and that Snowline will be the engine for that. So we do expect a major to acquire it within the next, I think highly probable within the next 3 years. And the longer it takes for major to acquire it, probably the more they end up paying, especially if we do see, price of gold continue to trend upward.
Okay. And I don't think I'm saying anything that hasn't been said publicly, but because of that buyout premium, you actively think it's a long to consider if you're interested in this space.
Yeah, yeah, we're long that, we remain long that. So definitely. I mean, we think this is the one real world-class greenfield opportunity that exists in a jurisdiction that's credible.
Okay, great. All right, two real quick questions as we wrap up here. One is there anything that's you're really covering passionately right now, or that's really burning brightly on your radar that I just haven't thought to ask you about yet, Carson?
Um, well, I mean, look, our core business is still activist short selling. Lots of companies out there still doing things that they shouldn't be doing. That's human nature. So, we're still grinding away there. We've covered momentum, and especially within the indices and flows, and why that's it's a space. The kind of returns that you can get shouldn't exist, but they do. I've covered some geopolitics and then also metals. So no, I think I, I don't know that these, and insurance. Insurance is one of these, things that's a little bit of a sleeper. I'm not sure exactly what to do with it. I don't know yet that I have actionable short theses in this space. It's just seen a decent amount of these problems, and so I think someday it will become a systemic issue. But so the fact that we even covered that, I think, has been pretty comprehensive.
All right, good. Well, again, if you get to the point at some point in the future where you're beginning to really actively worry about the insurance space, again, come back on and love to have that conversation in greater detail with you. Just on the Mike Green thing for a second. So I'm taking away from this, and you just tell me if I'm taking away correctly, but one of the last times I talked to Mike, he talked about how his firm Simplify had really isolated this passive factor in a way to be able to trade with it. And it sounds like that's kind of what you're doing there as well at Muddy Waters. So it sounds like you're saying, hey, there's really something there. Like this actually is something that gives you alpha as an investor.
Yeah, and I mean, look, I can't speak to how Mike and Simplify are doing it, but yeah, I mean, if you're looking at, like momentum is real. And what we found, actually, it's kind of interesting in looking at how our book has performed in real world, and also some portion predating October 24, or on back tests, like even this past year, like we were really, our strategy was really not in Mag 7 much. We only had minimal Mag 7 holdings. It was so it can kind of, you can find like this leading indicator. So for example, our largest holding in the strategy the past two and change months has been Western Digital, and also Micron was up there too. And so it seems like there's sometimes signal and momentum that's telling you something that's about to happen. And so the memory squeeze, and when on back tests, when we saw rotate, there was a rotation into energy on back tests that preceded, real outperformance there. So, and, so what, that's one of the interesting things about momentum is we're seeing, and I don't have high conviction in this yet because, I want to run this a few more years before really pounding the table. But at least as we measure momentum, like there are ways you can measure momentum where you find signal about the future in it. That's what that's one of the theories that, we're developing based on our experience here. So yeah, I do think there's something to this.
All right. Well, super fascinating, and I hope it keeps working for you for as long as
Me
you need.
too. It's a lot
Um,
easier than short selling.
I'm imagining, right? Exactly, right? So you can kind of understand the switch to the apostate role. Last question before we get to the most important one. Looks like you rock, do you? I'm basing that off of the picture on your X profile.
Oh no, that was I was doing the Murph challenge. So that was a 20-pound weight vest. I was doing push-ups. I don't know why I put that up there. There's a little bit of a flight of vanity, but
No, no, you should
no,
look, if you do Murph with a weighted vest on, that's a flex. Look,
I
I've
was
done
the only
Murph, it's no
person there
joke.
doing it. I mean, I was the last person to finish because I was the only person with the weighted vest. I thought everybody would have the weighted vest, but yeah, and the only reason I was able to finish on the pull-ups was because my son was there, and I just kept thinking, like, man, you do not want to teach this kid like to give up. Like, I don't care.
Man.
Keep doing the pull-up. So
That's super. So for folks that don't know Murph, it is I think it's a workout that's originated in CrossFit. It's dedicated to fallen soldiers, um, and it is 100 pull-ups, 200 push-ups, and
300 air
300 what?
squats.
Air squats?
Yeah, so
Okay.
you run a
Oh, and sorry,
mile.
you have to run a mile at the start, and then you have to run a mile after you've done all those, right?
Yeah,
And
yeah,
you're doing that
exactly.
with a 20-pound weight vest on?
Yeah, I did that with the 20-pound weight vest
Yeah,
on.
pretty
So
pretty impressive, buddy. Good
yeah.
job.
No, I'm now training for a marathon, be my first, and then I'll start doing some of the Spartan races. I did DecaFit in the fall. That was my first. So
Oh, cool.
yeah, no, I lost over 50 pounds back in 22, and that just kind of got me in this like, well,
You lost 50 pounds in a year. What did you do? Saw
over.
your legs off?
Yeah, I know, right? I, it was medium COVID that caused me to lose 15 in 2 weeks, a very unhealthy way. But I was suddenly sleeping a lot better. My blood test, which I just happened to go for my physical right after that, I thought was going to be abysmal. It was the best it had been in years. And so I said, you know what? You know the formula. Follow it, see how far you can go. And no GLP-1s. From that point on, I dropped another, like 35 to 40 pounds, just eating better, eating less, like avoiding snacking, drinking less, and making the time and exercising regularly. And yeah, so it's just kind of been a celebration of that. And I've got my son now is 12, but he's a really good distance runner. And I just went for a hike one day on a trail shortly after I'd lost 50-ish pounds, and he just took off and started running, and I was like frozen for a moment, and I thought, you're good enough shape, you could probably keep up with this dude, let's try it. And we just started running the trail, and I was like, man, like, this is awesome. I got to see what else I'm capable of. So that's what I'm doing.
Good for you, Carson. So on this channel, as regular viewers know, is a wealth building channel. So we talk about money all the time, but I do try to reiterate to folks as often as I can that money is a means to an end. It's not the end in and of itself. And true wealth, research is pretty clear on. It really boils down to quality relationships, having purpose in life, and good health. And I love it when, you know, experts that folks really respect, like yourself here, reflect back on people that, yeah, I'm a successful investor. I run this, big famous Muddy Waters company. We try to, give great financial gains for our folks. But in my own life, I'm really focused on the things that matter.
Yeah. So actually, can I riff on that for one quick moment
Yeah,
here?
please.
So to me, I like to distinguish, between being rich and being wealthy.
Hmm.
Like in finance terms, I mean, I'm not, I'm not that rich. I mean, look around the industry, guys are, I'm a rounding error. Um, but I think I'm one of the wealthiest people I know, and it's because I've become really focused on how I use my time. And so to me, wealth is the ability to use your time in the way that you want to use it.
Hmm.
So I mean, part of that's saying no to a lot of travel. It's having my own business. It's a mature business. I've hired people to do things, but it's given me the ability to put the time into exercise and to spend all this time with my family. So to me, like that's the goal, I think, is to have control over your time. So
Very, very well said, my friend. All right. Well, look, here we are at the end. Last question for you, Carson. Um, for folks that have really enjoyed this conversation and would like to follow you and your work in between now and your next appearance here, where should they go?
so on Twitter, I refuse to call it X. I'm at Muddy Waters Re. We also have the Muddy Water www Muddy Waters Research website where we post our reports. But yeah, just the Twitter is the best way, and maybe that Twitter account to which you referred, where I posted the picture, that's at Carson_C_block. I'm not really sure what content I should post on that. It's kind of rare, but maybe someday I'll have something profound to say that gets, placed on there.
All right. Well, look, Carson, I can't thank you enough. It's always wonderful, but I just very much appreciate you coming on here, especially so early in the year. Look forward to having you come back on this year. I mean, I'll reach out at some point, but like I said, if there's something that's really starting to catch your attention, please let me know. We'll pull you back in for that. But just thanks so much, buddy, and continue focusing on being the wealthiest guy you know where it matters.
All right. Hey, thanks a lot, Adam. Really enjoyed it.
All right, well, now's the time of the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by the lead partners there, Mike Preston and John Loder. Gentlemen, it's great to see you. John, why don't we start with you? Lots to talk about, a lot going on in the markets as we speak here, but any key takeaways from the Carson discussion you'd like to highlight for us here?
Hello, Adam. Great to be with you again, and thank you for having us. Got to thank you. I think many of your viewers oftentimes so compliment you on introducing them to new voices and names. And I got to say, personally, I wasn't familiar with Carson. Enjoyed his talk, and so thank you for introducing us to another viewpoint. I just want to put right out here, and this is not in any way a criticism, just a statement that there are many styles of investing, many tools in a toolkit, and many right ways, in fact. Our toolkit does not involve short selling, and certainly does not involve short selling in the kind of systematic, disciplined way that many firms have taken that strategy as part of their flagship approach. With that aside, I guess I want to comment on a couple of things. Carson did talk about the difficulty of the market to traditional short selling. In fact, we can go back and look in recent years, and there's been some very high-profile names that I don't want to say throw in the towel, but kind of have. You look at folks like, even the movie The Big Short, that for many lay people, that was their first even introduction to what it even means to sell short. Obviously, this was the big tale of the few souls that had the foresight to short big into the housing collapse of 0809, made a movie of it and book out of that. So many people, lay people, that was the first introduction to sell short. But almost like one after another, the big names in short selling have thrown in the towel. Michael Burry himself, one of the key characters in that movie, in that book, basically shut down his firm, Scion Asset Management. I think for a lot of the same reasons that Carson spoke about, it being a difficult market to be a traditional short seller. And the list goes on. Hindenburg Research was a notorious short seller. In January of 2025, they shut down their fund. And I think it speaks to, as Carson spoke, the markets have become very much controlled by policy versus good old-fashioned market discovery. And we can go on and wax poetic about how right or wrong that is, but it's the reality. And in many short sellers and many fables of short selling successes happened in an era way before things like quantitative easing were even a talking point, never mind a fixture in the central bank's toolkit. So it is a different environment, and it is, we think, a key reason why, despite the tremendously high valuations that we and others have been talking about for a long time, it hasn't mattered yet. We don't think it doesn't mean they won't matter. It just means this extend and pretend has been elongated for longer than normal market forces would probably allow for. So in that sense, we can kind of relate to a Carson share because, if it were purely due to valuations in the U.S. stock market, we could make a case to be essentially out of the U.S. stock market altogether. Yet we're not, and nor have we been. We are underweight stocks, and where we are invested in the stock market, we are picking certain sectors and avoiding other sectors based upon our systematic tools. And we have not an insignificant intentional allocation to non-U.S. stocks, both emerging and developed markets, in part because they're actually quite on a momentum and relative strength basis, have exerted themselves quite nicely. But they're also at much kinder valuations than the U.S. market. So a lot of what he talks about as being a frustration for him as a short seller, we can relate to as just a prudent manager of funds for everyday people. And I'll just say, short selling is we've talked a lot, and I'm sure we're going to cover at length here today. Silver and gold and precious metals have done phenomenally well. But as much as we celebrate, and folks will celebrate reading the headlines, there are times where that investment has been frustrating. You go back over the last decade, there were some times you had to be a faithful, convicted believer that there was a true fundamental play here, and it paid back all at once, so to speak. And that's the way short selling works, not just once in a while, but all the time. True short selling is you have the patience of Job, and you have to have the liquidity and the funds to hang in there until the big payoffs happen. And most people don't have the composition to do that, nor do most everyday people have the financial ability to do that, because they need their retirement savings to create that paycheck that they need to live on. So those are a couple big takeaways. I want to talk about, he alluded to and he references Mike Green a lot, who we obviously have followed and understand his take on the passive bid that has underlied these relentless markets, if you could use that word. What stops this train? I think we agree with a lot of the same things he talked about. Just even on the margin, a slowdown in the pace at savings in kind of retirement plans, for example, or even worse, or God forbid we have a recession, which we have little doubt we will have one. They're not banned from the future of humankind. We have little doubt about that, and it just takes on the margin a shift towards more conservative positioning, or starting to sell down to fund retirement, taking out hardship loans and things like that. If you look at some of the data, there's been a modest but trending upward trend in things like hardship withdrawals from 401ks. It'll matter probably in an instant, so to speak. So I wouldn't take this and like Carson, we don't fret every night the imminent collapse. We think there's ultimately a very large reset in the stock market, but right here now, we're not worried about it being imminent. But I wouldn't want folks to take that to mean you shouldn't be concerned, especially folks that are inclined to just be passively invested. That is, we think, going to be a recipe for very big disappointment, if not financial disaster for real people, if they just tune out for the next decade. So I'll stop there. Those are some big picture takeaways.
Okay, no, I think those are great. Let me pull on a few of those strings. So as I mentioned to Carson, a lot of people watching the video right now, they may intellectually understand that if and when we have that big correction, a corrective event, John, that the central planner reaction function might be swift, right? But as I was talking about with Carson, there's a period in between when the pain happens and when the response happens, and then you get the benefit of the response. And a lot of people here don't want to be collateral damage of that interim period, right? They don't want to necessarily look down, at their statement and see that they're down 40% or whatever, right? Mm-hmm. And there's no guarantee that the rescue is going to bring asset prices right back to where they were before, right? I mean, that would be the intent of the rescuers, but it might not happen, right? So, the big question is okay, so how do you navigate this such that you are, getting everything you need in terms of the income off of your portfolio, if that's what you're living on in your retirement, or just the capital appreciation that you need because you still have a decade or more until when you're going to retire. But have some downside protection in case that corrective event happens, during that period of time. That's kind of where you guys live right now as capital managers for your clients. So just do me a favor, just summarize real quickly kind of the New Harbor approach to that, because you're not hiding in the bunker, right? But you're not blindly long either.
Yeah, I'll just start with where we're currently positioned. We're about 47.5% in equities, traditional equities. Nearly approaching half of that now is in non-US equities. Okay. We also have about another 10% in gold mining equities. We've always thought of those as different than traditional equities, but if you add that in, we're close to 60% equities. But we for a long time have thought of gold mining stocks as different stocks. So you might as well say we're underweight a traditional 60-40 stock portfolio. But even within that, I'd say there is refuge to be had, and there has been in non-US stocks in certain geographies, like we have done so. So you can, again, some of the valuations that we have long kind of fretted in the US markets aren't so extreme in non-US markets. In fact, all you need to do is look at a chart of those markets going back to 2008, and they're not much up from there versus you look at the S&P 500, and it's like, 2008 looks like a little speed bump way in the past. I mean, that's a very simplistic way to look at the relative, valuation differential. But it starts with, well, I'm going to get philosophical. First of all, it starts with one's ability to sleep. There are plenty of our clients who've worked really hard, sacrificed, and created a stable situation. And being at peace with that, their biggest risk, should be not missing out on, the last gasp stages of a market that's way out over its skis, but in unwittingly suffering a decline that forces them to try to have to do a do-over, which they don't have the privilege of doing. Now, that requires an emotional toolkit more than an investment toolkit, one that is able to be okay, not winning in every last point, so to speak, right? And everybody has to, and we do a lot of work with our clients, helping them find their own piece of where that is, right? Calling their own top, so to speak, and being okay if their family members or their neighbors are boasting more loudly at certain events, if things are getting more frothy than they're fully enjoying. That's okay. Coming to terms with that form of regret is a very important investment skill. But getting to the toolkit, the investment toolkit, having a systematic approach to scale up and down risk as the markets speak to us, not in what the valuations say, but we look at a broad array of breadth and momentum indicators, and sometimes that just has to be listened to. And sometimes it's at the market level or at the sector level. We have long, as I think we talked about last week, we have long felt the energy sector had been left out of the party and had been, from a valuation standpoint, relatively quite compelling. But it lagged even despite that until like late last quarter, let's call it, of last year. And we saw some technical improvement there, and some of the systematic indicators saying, hey, this is a place that's not only attractively valued, but it's actually now got the wind at its back, so to speak. And it's important to have a rules-based, emotionless kind of guide to help navigate what will likely be very volatile markets, and going in places that right now, as bullish as we are as precious metals. I mean, base metals are actually quite attractive. They've been performing very well. Too, yeah. And we have some exposure to that, intentional exposure on an international level. We just saw a chart today in our investment chatter that, looked at the cost for major copper mines, and almost every last one, where current prices of copper are, imply very large margins relative to the cost. So I would not be surprised to see that sector. It probably won't be as explosive up like precious metals have been and are notorious for being, but there are lots of places to find value and opportunity, even despite this policy-driven, distorted market that we all have talked about.
Okay. All right, Mike, I'm going to come over to you. First, you want to add anything to what John said, and then I want to talk with you about the action in the precious metals because it's been fast and furious.
Yeah, no, I think John covered it really well. I think that maybe one thing I'd say is like, is that there's I think a lot of agreement in the notes that I've taken, and you guys talked about gold and junior miners. One positive um, that Carson talked about was that there's a macro tailwind because of what central bankers have been doing. They basically buy every dip. And that's bullish for gold. That's bullish for real assets. The world seems to know that the ultimate answer is just going to be more printing. When you have some of the things that have gone on lately, like criminal kind of charges against the Fed for not dropping interest rates faster, um, that's not a safe environment for investors if the central banks are not completely independent. And so on that news, the metals took off. And so we completely agree with that part. We'll talk about that in a little bit in a minute, but other than that, I don't really have too much else to add. I think you guys covered it pretty well.
Okay. All right. Well, look, let's talk about the precious metals. So we're recording this on Wednesday. I don't think this video is going to run until the weekend. So who knows where the precious metals are going to be when this video airs, Mike, because just every time I look, they get higher and higher and higher. I was watching last night as I think the price of silver went into, zoomed up to high 80s, broke into the 90s. As of this morning, silver futures opened around 92 an ounce. I think they've come off just a little bit since then, but pretty crazy, Mike, to be sitting here talking with you about $90 an ounce silver, especially when a year ago it was like 28 bucks an ounce. And you and I were bullish on where it was going to go. We thought it could have a breakout opportunity. I'm going to say neither you nor I thought it would go this far, this fast. Once we're up here above 90 bucks an ounce, the tractor pull of the big round number of $100 an ounce silver starts getting into investors' minds. And usually that helps kind of pull prices to that big psychological goal that folks want it to get to. So you tell me, what are you expecting here in terms of the momentum of the precious metals here? They are so stretched from their moving averages that there's a real danger of a snapback to those averages. But at the same time, they got a hell of a lot of momentum and they've got that big round number now trying to pull them towards it. So what do you think?
Well, let's look at some charts. It's difficult at times like this to stay unemotional. Part of our job at New Harbor is to help people not feel emotional, or certainly not to act emotionally. Charts don't tell everything. They can only tell you where we've come from. You can make a guess as to where we're going because of them, but certainly you can take a look at them and tell when things are getting extreme. And all I can say is that when things are getting extreme, particularly when they're extreme in your favor and all of your goals are getting met and then some, that's not a time to be greedy. That's a time to start thinking about doing something, taking something off the table. Let me just share a chart here, a couple charts. I'll start with the silver chart that we always look at. And you should be able to see it now.
Yep.
Actually, I'm just going to have to zoom out a little bit. All right, so you should be able to see that. So this is the daily chart of SLV, which is the ETF that tracks silver. You're absolutely right. We're almost at 90. Spot silver is about, I don't know, $6, $7 higher than this ETF. But this chart gives you a pretty good idea of what the shape is. So we've had nothing but gaps here lately. Gap, 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 gap. Like 5 gaps in a row. The market's getting exuberant. One thing I've learned in my career is be careful about shorting parabolic markets. You never know where the top's going to be. So I certainly wouldn't short this. But
But you also have the axiom that gaps ultimately get filled too, right?
almost always they get filled. And so we don't know if we're going to go higher and then fill these gaps. This is on the daily chart. And at the same time, we have the CME hiking margins. We just had another hike, I think, yesterday. This time it hasn't done a thing, right? So there's a lot of reasons why silver should keep going up, and gold. We're big bulls on real assets. We're very negative on central banking. We think the world is finally coming to the realization that this game isn't going to go on forever. I think that's probably what we're seeing. But even with all that in mind, things are getting really, really hot in here, So just bear that in mind. This light blue line is the 20-day, 21-day moving average. At a minimum, we should touch that at some point. This move has been so strong that we've gotten close to touching it, but then we've just taken off again. We haven't seen the 50-day in a long time. Now, I wouldn't wait around to touch the 50. All I can say is this. This is more and more and more parabolic, and in the last week or so, it's very vertical. We should expect some kind of correction relatively imminently. Would I bet on it? No, I would not. I would not short this betting on that. But if you have positions in metals that have doubled, tripled, or quadrupled, sell a little something and do something with the money. Do the home renovation, the kitchen, the dream trip, buy the RV, whatever it is. Take it off the table and make it real in your life. That's what we've been coaching people to do because they have so much. Some of these people that have bought back at 15 or 10 have nearly 10x their money. And so it's very easy to be all in. All in thinking is not going to be very helpful psychologically and or in terms of enjoyment in life because if you're all in, you never sell any. And a lot of people are like that. They just want to sit on it and watch it go up and up and up because it's fun. And you're never going to know when the top is. So, but now would be a good time to sell 5, 10%, 15%, something like that if you haven't sold already. That's all I'm saying. So, we're just, who knows? We got the round level of 100 coming up. I should show you the gold silver ratio here on the left-hand side. 50, 52 now. It was 103.
Yeah.
And we were talking about that back in April, Liberation
That has
Day.
halved. Yeah.
Yeah. So long-term average is around 40 to 60. I mean, some people will say the long-term, thousands of years average is 15. And I guess I can't disagree, but I can tell you over the last few decades, it's 40 to 60. So it has normalized. There's no longer a screaming undervaluation for silver. Why are silver miners underperforming? I have no idea. And take a look at silver up today. It's up about $4 still. So take a look at that up there. I put in silver miners, SIL, they're down on the day.
Is that a signal, Mike?
I don't think it's anything. I think it's the market not believing the silver move.
That's what I'm saying. Is it a signal that the market doesn't believe that this silver metal move is sustainable?
I think that's probably what it's saying. There's a lot of hand wringing going on, I'll tell you that, on Twitter and elsewhere about why silver miners are underperforming. I happen to think it's an opportunity. I don't think it's a negative signal, if that's what you're asking. But the market is starting to think it's a negative signal. But if you take a look at SIL, it had a nice base breakout, and then it broke out of this flat base right here. It's all beautiful. It looks good. And it's still holding. One thing I can say is that we're all impatient, including me sometimes. We want instant gratification. Silver goes up. We want silver miners to go up 3x. It doesn't work like that in the real world. The market, I've learned this the hard way, the market rewards patience, not impatience. Here's the junior, same thing. We broke out, sideways action. The market, I think, is going to reward patience. If you're not overweighted here, don't worry about it. There's just, I believe there's more upside in the silver miners than in silver. GDX and GDXJ have done a little bit better, relatively speaking, but the shapes of all of these curves are relatively the same. So we were basically saying with silver way back at 30, 35, watch the big triple top breakout. I mean, maybe you can go to the weekly chart here. Down here, I still have the line there. 1, 2, 3 tops.
God,
This is
look
a
at
weekly
that
chart.
chart.
Look what's happened since then. I mean, 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. If I go to the monthly chart, 2, 3, 4, 5, 6, 7, 8, almost 9 months. Straight up. Look what happened back in 2011. This is strong, much stronger than the 2011 move. And what's different this time, not only is it more weeks, but it's more persistent. But at some point here, we're going to have a wicked red bar here, and it's going to go that way for a couple months. And then we're going to have to see what happens next. So that's all I'm saying to people. Don't get too in love with this. Sell a little bit on the way up because that'll give you staying power.
Okay. Mike, can you go to the miners chart, the GDX chart here? Because obviously at New Harbor, your position's more in the miners than the metals itself. And to John's point, you guys don't short, but you do purchase downside protection for your big positions through options. So where are your hedges right now on the miners?
Well, we have kind of a unique situation in that we have half of our miners hedged and they're in the money. So, right now on 50% of our position, we've taken in accumulated credits, but our strike on half of our position is 80, right? So we might be capped out. You'd have to add up all of our accumulated credits, but we might have accumulated credits of $6 or $7 or $8, something like that. Let's call it $7. So that means 80 plus 7 is where we would be capped out at 87 on half our position. So that means we missed out some upside on half of our position. That's okay. That's the
Okay.
cost of our insurance program.
So
And by
sorry,
the
Mike, was that covered calls then?
This is covered calls. We
Okay.
do not have puts in place right now.
Okay. So basically, okay, so you bought some covered calls to get some income, but you cap your upside. The risk is that the stock runs to the upside, which it did in this case.
That's right. It did. Put the line out of the way there. The stock ran up to the up. We had this, and this has really been going on many different cycles here. But at present, we've rolled up to 80 with accumulated credits, which I'm going to estimate are around 7. So that means we've got a covered call on 57%. I'm sorry, on 50% at $87 or so. And that goes out to February, the third Friday in February. Now, here's the thing. If we keep going up and up and up, we're going to keep enjoying the ride. Now, our rebalance position back down at like 60, we rebalanced to 10%. That model position is roughly, let's call it 14% now because of growth. And so I know we always say 10%, but that's for new clients. We haven't rebalanced in many months. And so our average client size is maybe 13 to 14%.
Okay.
Half of that is hedged at 80 plus the accumulated credit, so maybe 87. The other half is free to run. It's always a balance between dampening volatility and providing hedges and giving upside. I would expect at some point we're going to have a sharp pullback. We have a sharp pullback to the 21-day moving average or even the 50-day moving average down here. Well, guess what? The half that's unhedged does get a decline, but the half that is hedged has dollar for dollar offset because of the in the moneyness. So it works both ways. If we fly higher from here, we're going to ride the 7% that we have. If we tank from here or correct, we're going to very quickly get back to close to 14% automatically. So it's hard to visualize, I know, but that's how it works dynamically. And we're just trying to smooth out volatility.
All right. Well, really interesting times from here. So let me ask you real quick, Mike, do me a favor, just pull up the chart of gold for a moment.
Okay.
I was talking about the pull of the big round number when it comes to silver, right, with $100 an ounce silver. Gold is trading now above 4,600 an ounce. Is that starting to get close enough to the big round number of $5,000 an ounce that Wall Street starts thinking about that, and the tractor pull of the mental desire to get there starts kicking in?
Yeah, let me show this chart here. This is GLD. Just don't have futures quotes on this platform we're using right here. So, we're 4,600. So just imagine that. This is 424. It's about, 400 points above that. So would be 4,240, but another 400. So this gives you a good idea of the shape of the curve, not the exact spot price. So you're right. We're getting close to 5,000. Gold, 100 silver. I've got no doubt we're going to get there. I just don't know that we're going to get there now. That's the big question. I mean, if I go back into the longer term charts in these things, and here's gold, triangle, sideways breakout, triangle, kind of up, and then consolidation breakout again. But these things are getting late stage. Here's a base, here's a base, here's a base, and a breakout three times in a row here. The first time the whole world is kind of sleeping. The second time, half the players start to take notice. The third time, everyone notices, So I don't know. I think it might be exactly what the market often does is it gets close to a number and then it just slaps you in the hand, and has a big correction. But I think a year from now or more, we'll be above 5,000 gold and 100 silver. There's a lot of people all over the internet saying they think we're going to be there now. And to be honest, I wouldn't be shocked if we get there really quickly. But it's a super bullish chart. It's getting close. I don't know. Your guess is as good as mine, Adam. I'd still be ringing the register a little bit if I had a big position.
Yeah, no, well, I mean, I totally agree that, either position rebalance, which we talk about doing all the time, or if you've got ounces that you just don't want to sell, then hedge, right? And it's funny, I get so much pushback against this because, the metal's been running so hot. People have been saying, well, this is why you don't want to hedge. And it's like, well, yeah, I mean, hedging is never sexy when prices are going up.
Well, that's
It's
right.
only sexy when the price action stops and then people all of a sudden really wish they had insurance in place. Um, Personally, one man's opinion, so this is definitely not financial advice. I wouldn't be surprised, Mike, to see $100 an ounce silver. I think it's probably more likely given how close we are, but also $5,000 gold. I wouldn't be surprised to see those in the relatively near future. For me, the bigger question I have is just how long will those prices sustain? Do we touch them and then have a big pullback and some long period of time of trying to work through all the froth before they start going higher again? Or, is it really truly a brand new price regime and, those become the new floors? I don't know. Totally TBD.
Well, we'll see. Just remember, we get these calls all the time for hedging. It's very expensive to hedge with puts. All right, so you really want to be selling covered calls if you can. If you happen to own gold in the form of GLD, you can sell covered calls, or you just want to be selling on the way up. I can give you a really quick example here. If I look at GLD and I go out to 1 year from now, you probably can't see this on the screen because it's so small, but the current price is like 425. And let's just see what it would cost to buy a put. If I bought an at the money put, 425, it'll cost me $29 a share. 29 divided by 424 is like what, 6% maybe? That's not horrible. I mean, I guess if you want to pay 6% of your pile, we can basically say you're not gonna, no matter what, you're gonna be able to offset the downside, but that gets pretty expensive over time, so it's much better to sell some covered calls and take in some income or just sell on the way up.
All right. Well, look, wise advice as always, Mike. So we'll wrap it up there, just given where we are time-wise. John, I'll punt it back to you for closing remarks here. For much of the past 2 months, we had been advising people, hey, you know, don't procrastinate in taking care of whatever end of year deadlines you're going to need to meet, whether it was minimum required distributions or charitable donations or whatever. Okay, so we're past year end now. Now that we're here at the beginning of a new year, do you have any advice for people in terms of things they should be doing now or considering now to set themselves up well for the full year that we have ahead of us?
Well, yeah, I mean, a lot of last year was about, hey, how do we kind of minimize, realize most people especially people that just sat there and did nothing even, had a pretty good year and maybe even better year than they imagined they would. And with those gains comes the possibility of capital gains taxes. So we certainly did all we could to mitigate how much realized capital gains our clients booked last year and therefore owe taxes on. And we did a pretty good job. We talked about our hedging strategy with the miners. One of the silver linings there, excuse the pun, is we were able to in doing those call rollouts and roll-ups, we were able to harvest some losses on the way doing that. So it's kind of like we got to keep the stock, still appreciate some upside, gave away some upside, but also harvested some losses in those calls. But now that we're in a new tax year, this may very well, especially if you have an outlook like we do, that eventually we'll probably see some real downside in this market, and very likely this year at some point. By all means, think about taking some gains. Ideally, if they're long-term capital gains, you've held them longer than a year, you're going to get taxed at a favorable rate relative to most people's short-term capital gains tax rate. So think about that, and no better place to think about than the metals, like we talked about. Selling some winners here and right sizing positions is probably the most important thing someone can do, even in a strong sector, because if they're overweighted, it becomes unhelpful to the situation because nothing goes up forever, not even precious metals. So that's that. I'm looking. I'm actually looking at some questions. We actually have a live Q&A. We do live Q&As for our clients every month, and we have one tomorrow. And in fact, Adam, if you'll indulge us, we'll we do get a lot of prospective clients that join in these as well. Certainly, your viewers, if they wanted to tune in, they could find our live Q&A. I think have it advertised on our LinkedIn page and perhaps even Twitter. But we got a lot of questions. A lot of the questions have to do with inflation, precious metals. Is it too late to get in? Should we sell some? Taxes. I'm just looking at the other things here. Psychological aspects of money. So we have a pretty far-ranging, roster of questions that almost is like a day in the life of the kind of work we do with clients. And I invite your viewers certainly to come join us, submit questions in advance or live during the broadcast. But happy to kind of answer any questions anybody has. But
Great.
these are the real everyday things we help our clients with. And
So John, sorry, when is that Q&A?
that's tomorrow. Sorry, I should have given you the.
Yeah, so just
It's
FYI, this video is going to be released after that day. But
shoot.
hopefully folks can catch the next one that you guys do.
Well, we do them every month. So every month, and I apologize for the goof up on the calendar there. Yeah, but we usually do them on kind of first or second week of the month, and usually 2 p.m. Eastern for an hour or so. And love to have people tune in.
Great. All right, just in wrapping up this topic, so you mentioned capital gains, John, and I just want to give folks a quick refresher. So when you have capital gains in a financial asset, there are two types of capital gains taxes that can come into play. One that definitely will is the federal capital gains, and those range from 0% capital gains tax to 20% on your long-term gains. So I'm sorry, let me step back for a second. Two types of capital gains, short-term and long-term. Generally, if you've held the asset for less than a year, it's going to be taxed at a short-term capital gains rate, which essentially is going to be taxed as income to you. So whatever your marginal income tax rate is going to be, your short-term capital gains are going to get taxed at that. If you've held them for over a year, they'll be taxed as long-term capital gains. And there are three types of federal long-term capital gains tax rates, and they depend upon what your taxable income is. And you'll see here right now, this tax schedule here, but basically it's 0% below a certain threshold. Above a certain threshold, it's 20. And if you're somewhere in the middle, they'll be taxed at 15%. So that's what the federal government's going to tax you at. And then if you, depending upon what state you live in, you'll pay state capital gains tax if your state taxes capital gains. Not all states do. So like the state I live in, Nevada, doesn't tax capital gains. It's one of the reasons why I moved here. But primarily it was because it doesn't have income tax in Nevada, which is the bigger deal for me. But the way in which these capital gains are taxed by state differs. So, for example, if you live in California, which is the state I lived in, no matter whether it was a long-term gain or a short-term gain, they're going to tax it at your top marginal income rate. Again, this all differs state by state, so obviously check with your CPA or whatever. But guys, I just wanted to share that because I think for a lot of people, they kind of know they have to pay capital gains, but they don't really necessarily understand all the math that comes into play. But those are the factors.
Adam, glad that you highlighted that. And just like you did, I'll reiterate, this is not personalized tax advice because it gets down to very specific things. But other things you got to be careful about there is not unsuspectingly invite other issues. Like there's a rule called IRMA, basically, and I forget what it stands for. It's an abbreviation, but capital gains realized adds to income. So in respective calculated Social Security taxation and Medicare surcharges, things like that. So you want to be careful that you don't lose sight of some of these other tax-related stuff and get an unexpected surprise there.
Right, and again, I'm not a tax advisor, so obviously go speak with yours. But I am guessing too, John, as well, that if you are taking on capital gains that are taxed as income, it could potentially, if you have a big enough capital gain, it could bump you up into the next marginal
Oh,
tax
absolutely.
bracket, right?
Yep. Absolutely. Absolutely can.
Yeah.
And one thing you didn't mention, Adam, that we talk with clients about too, again with the caveat that we're not tax experts, is the NIIT, a tricky little tax called the net investment income tax. So here's a little tricky one. I'll just show you right on the IRS's website. If you have income from investments, you might be subject to this. If your modified adjusted gross income exceeds 250K if you're married, 200K if you're single, and MIGI, by the way, Maggie, includes interest, dividends, capital gains, etc. So even if you have, let's say, $100,000 income, but you take a $200,000 capital gain, that chart you just showed shows that if you're under 545, I think it is for a married couple, you're going to pay 15%. But guess what? You're also going to pay 3.8% NIIT. So it's a little tricky, but it's just an additional tax people should know about. And if you can avoid it by staying under those limits, I'd say avoid it.
Okay. So I think to the spirit of my original question to you, John, um, I think maybe a really good thing that most folks should consider doing at the beginning of a year is revisiting their financial plan, right?
Absolutely.
Let me update the financial plan. Let me, what's changed over the past year of my life? Have my forward expectations changed at all? Let me get my financial plan up to date so I know where it's going. But then you can use that to kind of come up with your income projections for the year and whatnot. And then you can, that can then really inform you for having some discussions with your tax advisor about, okay, how can we make sure I don't trigger some of these other additional taxes I might be subject to this year if I do things differently from the start? So obviously you guys do a lot of financial planning for clients, correct?
Absolutely, we do, Adam. It's part of the package.
Part of the package. All right, folks. Well, look, highly recommend you set yourself up for success this year by doing a lot of the things we just mentioned there. If you do them on your own as a DIY investor, great. If you have a financial advisor who can do all that for you, great. But if you don't, or you'd like some help from one of the financial advisory firms that Thoughtful Money endorses, maybe you might even want to talk to John and Mike and their team there at New Harbor Financial. Highly recommend you just take this action. So anyways, a really good first step to that could be, again, if you don't have a good advisor already advising you, talk to one of these guys that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. The consultations you'll have subsequent to that are totally free. There's no commitments involved. Either it's just a service these firms offer to be as helpful to as many people as possible. But the key thing is just make sure you're setting yourself up for the greatest chances for success at the beginning of the year for the full year. Also, folks, if you'd like to see Carson come back on this channel again at some point this year, please let them know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it if you haven't clicked that already. Just in talking about the precious metals, just a reminder that the special offer, the exclusive offer that Andy Schekman, CEO of Miles Franklin, has offered to the Thoughtful Money audience for buying junk silver for just $1.35 over spot. Supplies are still lasting on that for the time being. So if that's something you might want to take advantage of, just fill out the very short form at thoughtfulmoney.com/buygold, and Andy and his team will be in touch with you right away. And not only can you talk to them about the junk silver offer, but if you've got additional questions about buying, storing, or selling precious metals, they can help you with all that as well. John and Mike, thanks again for yet another great week. New Year's off to a strong start. Thanks for being with me here. Look forward to doing this with you all through the rest of the year. And very much appreciate all the help that you guys have done for all the many people that the Thoughtful Money channel has sent your way. I get a constant stream of folks saying how much they appreciate the service that you guys and your team provide them. So just want to say thanks so much for your partnership.
Thanks to you, Adam, as well, and your viewers. Thank you very much.
Thank you, Adam. Always a pleasure. Thank you for those kind words. We're privileged to be able to do what we do, and thank you and all the folks that have reached out to us through Thoughtful Money.
All right. Well, thanks so much. I got a lot of travel coming up in the next week or two, but I think we'll still be on the schedule here. So look forward to having you guys here next week. But yeah, I'm going to Houston and then I'm going to Vancouver, all for conferences. But somewhere, somehow on that road, we'll get together and record next week so folks can hear your latest update. Thanks so much again, boys. Really appreciate you being on this journey with us. Everybody else, thanks so much for watching.
That we're still at above 2.5%, close to 3% in the US inflation, consumer price acceleration rate, and the interest rate has been being cut since 2024. You can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case. This is going to be much worse for the dollar, and it is going to be the end of it because the debt is so much higher now. The end game is coming. It is coming soon. And this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
U.S. inflation remains near 3% while the Fed continues cutting rates, pushing gold higher alongside rising consumer prices. This policy shift is set to hit the dollar hard, given today's much larger debt levels. Analysts warn the endgame is near, worse for dollar holders than in 1980. But far more rewarding for gold and silver investors, as this time gains are expected to be sustained and even surpassed. Rafi Farber, known as the Endgame Investor, is a financial writer, investor, and precious metals analyst. Recalls that back in 1980, the Fed fought inflation by targeting monetary aggregates, money supply growth rather than just consumer prices. With debt to GDP at only 32%, they could hike rates aggressively, eventually taming inflation and stabilizing the dollar. Today, however, debt to GDP is near record highs at around 120%, leaving no room for similar rate hikes. Instead, the Fed is cutting rates into rising consumer prices and a rising gold market. Unlike 1980, this environment signals a much weaker dollar and far stronger prospects for gold and silver, with gains expected to surpass those of the past. Remember to hit the bell symbol and subscribe as we begin the videos so you don't miss any updates. If you like the video, please leave a comment below and give us a thumbs up.
They wanted the monetary aggregates is the M1, M2, M3 money supply. This is back at the time when the Fed was actually trying to control inflation in a classic sense. Inflation meaning the amount of dollars over the gold supply, how much the monetary aggregates are actually rising. That is inflation in the classic sense, just as they changed the inflation to the effect of inflation, which is the effect on consumer prices, just as they changed the definition of vaccine to what it was before and what it is since COVID. I'm not going to go into that now, but it's the same kind of Orwellian nonsense. But this is back when the Fed actually was not actually fighting inflation, but trying to control inflation, meaning the actual monetary aggregates, the money supply numbers, not the effect on prices. They didn't care, not that they didn't care. It wasn't their primary goal to change the effect of prices, of consumer prices. They knew that if they attacked the monetary aggregates and controlled the expansion of the monetary aggregates, they would, by extension, control consumer prices, which they did in the end, which is why we still have a monetary system as it was in 1980. So basically, at this point, the Fed is jacking up interest rates in order to control monetary aggregates. And we can see here by this chart, when they hike into the maximum, exactly when this is, I think this is early 1981 or something like that, once they see that the monetary aggregates are within the growth ranges that they prescribe, then they get control over consumer prices over here in the red, and they get control over the gold price, but this is of course not their primary goal. They want to control the monetary aggregates, which will control the consumer prices, which will also control the gold price by extension, and then they start cutting rates once they see that this is under control. The other reason why this is not a 1980 situation is that you can see the debt to GDP ratio. I know GDP is fake, but this is still a general relative number that does convey some information. The debt to GDP ratio in 1981, when interest rates were at a maximum, was 31.8%. This is, I think, an all-time low since Andrew Jackson, maybe. Maybe I'm exaggerating that. I didn't look into the 19th century. I can't find statistics for debt to GDP ratio in the 1800s, but you can see that this is the lowest debt to GDP ratio. This is precisely when gold was topping and when inflation, consumer price inflation, was topping out. This is why they could jack up interest rates so high, because the debt was so low by comparison to any other year from World War II, at least before World War II, the Great Depression, until now. That is why 1980, the dollar survived that turbulence. But now, of course, we are at 120% or whatever it is, the very, very near an all-time high in debt to GDP. There's no way that they can raise interest rates now, which is why they're cutting it, and they're cutting it into rising consumer prices. You can see here, this is the chart of the interplay between the U.S. inflation rate. Inflation, I mean in quotes, not really the inflation rate, but the consumer price acceleration rate. And gold you have here, I don't know why it's not in gold. What is that, gray or green or whatever the hell it is? And you have here the blue U.S. interest rate, the federal funds rate. And you can see here that we're still at above 2.5%, close to 3% in the U.S. inflation consumer price acceleration rate. And the interest rate has been being cut since 2024. You can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all. So people that say you can't compare to 1980, this is not that situation, stop using those ratios, I agree. This is going to be much worse for the dollar, and it is going to be the end of it, because the debt is so much higher now. And unlike 1980, when they were cutting into a falling consumer price inflation environment, now they will be cutting into a rising consumer price inflation environment. And while debt to GDP was so much lower in 1980, it was lower than any time before World War II since the Great Depression. Now it is at an all-time high. There is nothing they can do. They have to cut into rising consumer prices because the debt is so high. Where in 1980, they didn't have to do that, and that's why they saved the dollar, and that's why they will not this time. So forget about the Hunt brothers. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders, and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
Rafi Farber points out that in 1980 and 81, U.S. inflation and gold prices were surging while the Fed raised interest rates aggressively to regain control. After briefly cutting rates, they were forced to hike again up to nearly 15%, when money supply growth ran hotter than expected. Only once inflation consistently declined did the Fed start cutting rates steadily, which helped stabilize the system and prevented the collapse of the fiat dollar. Now let's review the interview.
And so here we have a chart with three colors, blue, red, and some kind of yellowish, greenish, orange, whatever blah that is. You can tell me later in the comments how stupid I am at colors, but whatever. My eyeballs are my eyeballs. What can I do? So this one, which I think is the red one, is the U.S. inflation rate. This one, the blue one, is the gold price. It's not exact. And this one over here, this wobbly one is going down over here, and then back up, blah, 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 blah. That is U.S. interest rate, meaning the Fed funds rate. Now, what was going on here in 1980? What was going on was that interest rates were going up and up and up and up, because the U.S. inflation rate, the inflation in quotes, the inflation rate, meaning consumer prices were rising. They were rising and rising and rising. And so the Fed was raising and raising interest rates, but not quite. We'll go into why not quite. That's not what was happening in the next slide. This was a situation where interest rates are rising, gold was rising, the inflation rate, the consumer price inflation rate was rising. And then you have this period here where they were cut, the interest rates were cut back down here to whatever that is, I think 5%. And then they were jacked right back up to about 13, 14% right here. And we'll see exactly why this was in a second. But you can see here that the Fed was trying to quash consumer prices, not exactly consumer prices, but we'll see why in a second. They were trying to quash something else. And as they were doing that, finally, when they got control of the U.S. inflation rate, when the red line started going down, that is when they consistently started cutting rates over here in this greenish, yellowish, whatever line that is. And you can see here that the gold price was falling with it as well. What I'm trying to say here is that back in 1980 and 1981, the Fed was raising rates, trying to quash consumer prices, and only once they accomplished this goal and they saw that the inflation rate was falling consistently, only then in 1981 did they start cutting rates on a consistent basis as consumer price inflation was falling, as the acceleration in consumer prices were falling. So in other words, the Fed already had control of the inflation rate when they started cutting on a consistent basis. That's what happened in 1980, and that is why, one of the reasons why, the fiat monetary system did not end in that year. This is not really a chart. This is a transcript. I will give you the link in the description below as to exactly where you can find this thing, and it's on page 7 of the PDF that I found it on at the Federal Reserve's website. This is to a staff analysis, says the Federal Reserve Board. The demand for money had been quite strong in recent months because of recovery in economic activity and in nominal GNP, not GDP, GNP, slightly different, had been much larger than anticipated. Growth of transaction balances was projected to slow significantly over the remainder of the year, in part because of the lagged effect on the demand for money or of the sharp rise in interest rates over recent months, and in part because of the apparent weakening of the recovery in activity. In the committee's discussion of policy for the period immediately ahead, the members generally favored pursuit of a sharp reduction in monetary expansion from the rapid pace of recent months. And so, if we go back to this chart over here, this is November of 1980 when they started to raise rates again after cutting them over here. This is 1980s around here where I'm circling when they started to raise rates back up to the maximum around 15%. Why did they do that? Because they saw that the monetary aggregates were rising at a faster pace.
Unlike 1980, when the Fed had the flexibility to crush inflation with aggressive hikes, today's debt-heavy environment leaves policymakers with fewer tools. Cutting rates into rising inflation risks undermining the dollar while fueling gold and silver to new heights, suggesting this cycle could deliver far more lasting gains for precious metals. Could today's debt levels make it impossible for the Fed to repeat the 1980 playbook? How high might gold and silver climb if the dollar continues to weaken under current policies? Please feel free to leave a remark below with your thoughts. Please give this informative video a thumbs up and subscribe to receive our most recent updates. Thank you for joining us on this trip.
Right now, silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge. If gold just stood still and silver went to, 2% of it, silver would be $70 or so, But gold will be going up there in that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position, we said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000.
Silver is gaining momentum and looks set to outperform gold, with analysts expecting it to break past its old highs and potentially reach $60 to $70 as it catches up. Even if gold held steady, silver could rise to around $70 at 2% of gold's value, but since gold is also climbing, silver's outperformance is likely to accelerate. With gold's rally restarting and long-term projections pointing as high as $10,000 to $20,000, the strongest focus right now is on silver within the monetary metals. Michael Oliver is a seasoned market analyst and the founder of Momentum Structural Analysis. He explains that gold has spent the past 5 months consolidating in a sideways range, frustrating skeptics who expected a major correction. Instead of falling, gold held firm and is now breaking above $3,500, signaling renewed momentum. This pause acted as a cooling-off period, setting the stage for the next surge higher. Analysts suggest this rally will be powerful but not the final peak, with potential targets of $10,000 to $20,000 in the long term. Silver and gold miners are also showing strong outperformance, with silver expected to surge towards $60 to $70 before any meaningful pullback. Unlike past rallies, this move is supported by deeper global and macroeconomic shifts. The dollar index has been flat for nearly a decade, yet gold has more than tripled, showing that other forces are driving demand. Weakness in treasury bonds, signs of a topping stock market, and risks of a sharp Bitcoin decline could all funnel more money into precious metals. With these pressures building, gold and silver may see explosive upside before year-end, as investors rush to safe havens amid mounting financial instability. Before we begin, please subscribe and enable the notification bell so you stay up to date. We'd love to hear your thoughts, so please share them in the comments.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly. Like 3 times it got up to 3,500 or 3,450. Right now we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it and they kept getting these $100 and $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get a further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar has not been a factor, the dollar index, when you measure versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So, yeah, it's been above it and below it since then. But 10 years, it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further wind for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because of financial institutions that are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Michael thinks that gold's rise since 2015 can't be explained by the usual drivers like a weak dollar, falling stocks, higher commodities, or bond shifts. Instead, it reflects something bigger, deep distortions created by government control of money. These forces are converging, setting up a cascade that could spark central bank panic. Silver is expected to break past its old $50 high and surge towards $60 to $70, drawing in late investors before any correction. Still, that would only be a pause, not the end of the bull run. Historically, gold has delivered two eightfold moves in the past 50 years, and repeating that pattern today would put it near $8,000. Analysts argue this wouldn't even be unusual. It would simply mirror past cycles. Michael predicts that if gold does reach those levels, silver could climb dramatically as well, possibly reaching 2% of gold's price. Commodities may follow along, but the real fireworks are expected in gold, silver, and mining stocks, making the coming surge both dramatic and highly concentrated in monetary metals. Now let's revisit the interview.
Explain, we showed in the weekend report the chart of gold since 2015, and there's this upward plotting action and then it's accelerating. And you say, well, what caused that? And it wasn't because it was the declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so it will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because they could go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move. You go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.
Michael Oliver highlights that both gold and silver are entering a powerful new phase, driven not by traditional market factors but by deeper systemic distortions in the global monetary system. With gold potentially targeting $8,000 to $20,000 and silver set to surge past its old highs towards $60 to $70 or more, the precious metals market may soon witness one of the most dramatic bull runs in history. This rally, fueled by weakening confidence in traditional assets and central bank actions, suggests that silver and gold miners could offer some of the strongest opportunities in the coming years. If gold were to reach $8,000 or higher, how high could silver realistically climb relative to gold's value? Do you think central banks will intervene directly in the silver and gold markets if the rally becomes too explosive? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
Same time U.S. declares silver as a national priority, you have Saudi Arabia buy a bunch in SLV. You see India's demand of silver is up 431% year over year in May, and record ETF inflows in June despite higher prices. So yeah, I mean, there's a lot of demand for physical metal that hasn't translated into the retail side of it yet. But the rest of the world, the big money, whether it be on the exchanges or the central banks or the sovereign wealth funds, are making it very clear that silver and gold are quite significant, and platinum, to their plans.
The U.S. has officially declared silver a national priority, signaling its rising strategic importance. At the same time, global demand is surging. Saudi Arabia has been buying large amounts through silver ETFs. India's silver demand jumped 431% year over year in May, and June saw record ETF inflows despite higher prices. While retail demand hasn't yet fully caught up, institutional investors, central banks, and sovereign wealth funds are clearly positioning silver. Andy is a well-known precious metals expert, CEO of Miles Franklin Precious Metals, points out that a large amount of gold and silver has recently flowed into COMEX, with September deliveries hitting 267,000 ounces of gold and 42 million ounces of silver, an unusually high figure. At the same time, short positions in SLV are surging, signaling major moves behind the scenes. The recent BRICS and Shanghai Cooperation Organization meetings also highlighted a geopolitical shift. Trump's threat of 50% tariffs on India seems to have backfired, since U.S. trade only makes up less than 3% of India's GDP. This is why leaders Xi, Modi, and Putin demonstrated unity at the SCO summit. Andy highlights that the SCO is not a minor group, it represents over 40% of the global population, 35% of global GDP, and nearly a quarter of the world's land area. Modi emphasized India's strategic autonomy, making it clear they will not sacrifice long-term interests. Meanwhile, China is investing in mandatory AI education from primary school upward, preparing its youth for technological dominance, while many Western youths focus on social media aspirations. This difference in priorities, combined with U.S. policy missteps, risks leaving America behind. Adding to that, U.S. stock valuations are now at record extremes, higher than even during the dot-com bubble and Great Depression, with investors heavily leveraged and exposed. Insiders appear to be exiting while the public piles in. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
A lot of gold and silver coming into the market, into COMEX. So far for September, 267,000 ounces delivered, 42 million ounces of silver delivered, which is huge. We talked about the shorts are up big time in SLV, which is huge. We talked about the BRICS meeting, the Shanghai Cooperation meeting. I think what I take away from that is that Trump overplayed his card with India, threatening 50% tariffs. When you look at the actual numbers, even though we are their largest trading partner, arguably, it only accounts for under 3% of their GDP, their trade with us. You look at a country like Mexico or Canada, where it's the majority, that's different. We'll have greater weight. The purchase of Russian oil for India is far, far more important to them. And this is why you see Xi and Modi and Putin shake hands and smile and hug at the Shanghai Cooperation meeting. The SCO is no small organization. I've talked a lot about it on your show. It's over 40% of global population, 35% of global GDP. 24% of the land area. And so when you talk about takeaways, I think the fact that Modi stresses strategic autonomy, will not trade long-term interests for short-term appeasement. And, they're making stronger ties with Russia, with energy and defense and security. One of the things that I found interesting was that China is now embarking upon mandatory AI education from primary school, building all the way up through high school to build a AI talent pipeline. And so I found that to be very interesting. I also found it interesting that of all of the Gen Zs polled, that the number one job that came out on top wanting to be was a social influencer. And yet you have all of these kids in China that are becoming engineers and astronauts and becoming proficient in AI from elementary school on. These are the things we're getting left behind, whether it be in the way that our kids are being raised with education, or what's happening in our U.S. foreign policy missteps under the Trump administration. As much as I would vote for him again, I think he really overplayed his hand with a country like India. And, I think that these are the kind of mistakes that are going to have ramifications with the continuing emergence and strengthening of not only the Shanghai Cooperation Organization, but the BRICS. We have not heard the end of that yet, but I found it interesting that more or less Modi came out and said, we're not going to back down from our relationship with Russia and or our oil purchases from them. It's more important than just about anything right now. So how this all plays out, I guess we'll see. But putting 50% tariffs on India was, I think, a big misstep. And that's what I took out of the Shanghai Cooperation Organization meeting. Other than that, like I said, likely to see payrolls be revised. I've read from anywhere from 500 to 800,000, which they will use to justify rate cuts. But when you have U.S. stock valuations now at the most expensive in history, surpassing the dot-com and pre-Great Depression levels, you got some serious risks ahead if indeed they do this, as the public is all in on equities, all in on margin, all in highest ever, and all in on options exposure highest ever. That's a dangerous market as the insiders are moving this way, the other way. So I don't know. It's Not too much happened that is off the charts this week. I'm sure there will be by next week, but just more continuation of the same.
Andy explains that 8 major Western banks hold the largest concentrated silver positions ever seen on COMEX. This isn't just about controlling price. Though prices have been deliberately suppressed, it's mainly about maintaining access to silver stockpiles. Silver is unique because even tiny amounts are critical in high-value products, from cruise missiles to iPhones, so availability matters more than price. Rising prices would attract investor demand, but there isn't enough supply to meet it, which is why the market has been manipulated. Now, however, silver is recognized as a truly strategic metal. Although silver has risen to around $42 in mid-2025, a level many would have celebrated a year ago, analysts say this is just the beginning. With global players like Russia, India, Saudi Arabia, and China aggressively buying, and U.S. demand on COMEX also surging, the market is tightening. Once the retail side wakes up to this reality, shortages could spill over worldwide, and that's when silver prices may truly explode. For now, it's still an opportunity for early investors before the real fireworks begin. Now let's dive into the interview.
Banks, and I'll talk about Ed Steer's chart again that you showed several months ago. When you see 8 Western banks that maintain the largest concentrated position of any commodity ever traded on COMEX, it's not to hold down the price. Well, it is, but it's not price that's bothering them because silver is inelastic. You don't need a lot to make a very expensive item. Even if it's 500 ounces in a Tomahawk cruise missile that costs millions and millions of dollars, or a fifth of or a sixth or an eighth of an ounce in an iPhone, the cost of the finished product is so much higher than the little incremental price of silver. It doesn't matter. More along the lines of they've tried to step on it because rising price would attract demand. And there's not enough availability of it. The price has been skewed by the trading on COMEX and the LBMA. It's real value skewed. And so I think the rising price would attract investors, speculators. They don't want that. It's more along the lines of being able to access stockpiles of silver rather than the cost of the silver. I know that sounds kind of strange, but if you're making it for all of these critical components, it's less about the price and more about the availability because it's used in such small amounts in whatever the finished product is. But you're right. It has been suppressed. It has been held down. It has been manipulated. And I think now there's a race to accumulate it because indeed it is strategic. It is critical. It is needed not just in electronics and electrical components, just about anything that conducts electricity. It is needed in military components. It is needed in medical devices. It is needed in so many places, solar panels, etc. And that plurality of demand, from monetary demand to military demand to industrial demand, makes it strategic, every bit as strategic as any of these other strategic metals. And I think that's the change, is that Trump understands it, his administration understands it. So, this is something I think that will continue, and there will be at some point, I see a battle between the industrials and the, or shall I say, the manufacturers, the producers who need it, and the investors. So you're going to get companies like Tesla and Panasonic and Sony and whatnot in a battle for what's available. As the hedge funds and the investors start to take the other side, they're going to battle, and it's about availability of a depleting asset. It's not as much about the price, but just about the availability. And you start to wake everyone up just like that. It disappears. And what is a shortage on COMEX spills into a shortage globally across the board into retail as well. Not there yet. There's still great values, but I see that happening as where this ultimately goes to. But if I would have told people, a year ago that we'll be staring at $42, in early, mid-2025, I think most people would have been happy about that. Quite frankly, I think it's just beginning. We're a long ways away from seeing where this ultimately stops, but this is where it should have been a long time ago, and I think it's still got a lot of room to run based upon everything that I'm seeing, whether it be anecdotally or economically, or just by the movements of the biggest players in the world with Russia and India and Saudi Arabia and China. They're all gobbling up silver as fast as they can. Evidently, so are the folks in the United States now, too, at least on the COMEX. When that translates to the retail side, which I believe it will, something will wake up the public, that's when we'll see real fireworks. And of course, we're not there yet, but that's a benefit to all of you who are trying to add to your portfolio before the prices get out of hand.
Silver's transformation from a quietly suppressed asset to a recognized strategic resource marks a turning point in global finance. With record institutional accumulation, geopolitical realignments, and growing industrial needs, the foundation is being set for a historic silver bull market. The window for early positioning is narrowing, as both governments and major investors move ahead of the public. How soon could retail investors begin to feel the global silver shortage already affecting institutions? Could U.S. policy missteps accelerate silver's role in a new multipolar financial system? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.